Hi everyone, welcome back. I'm here. I will share with you my view of the market for this week. As usual, we take a look at the calendar to see what we can expect from the macroeconomic point of view and a little review of technicals for the upcoming days, right? So I will start sharing the macroeconomic calendar. You know, the week start with a holiday. Hope you're seeing it fine. Um, of course, there's only one and only thing the market is thinking today, and that's is the upcoming Fed meeting next Wednesday. We had some figures coming out. We will discuss it, but the focus is no doubts in the upcoming Fed monetary policy meeting and decision rates and um, about rates and the monetary policy path. Sorry. Anyway, uh, I was reviewing what happened in the previous Fed meeting, right? And of course, beyond the hike and the move we had, I was thinking about the statement and the wording and see what we can expect for this particular meeting. And market hopes of three rate hikes this year, fuel last December, have been decreasing lately. And the shift, more relevant shift from the Fed seems to come from the policies they will apply from now on, right? We have been 100% focused on rate hikes. Policymakers have been anticipating the rate hike for 2 or 3 weeks, speaking but nothing about that. And all of a sudden, after the latest move, we've seen a shift towards reducing the balance sheet, right? I was checking today that ever since the 2007-2008 financial crisis, the Fed has added $4.5 trillion to its balance sheets in bonds and mortgage-related securities. And of course, it needs to reduce it. But I also checked that in latest FONC meeting, Janet Yellen said that the uh, the change in the balance sheet, upcoming monetary policies decisions will depend not only in the quantity of the information, but also in the quality of such information, right? So, for the most, the Fed remains data dependent. And what we have seen ever since mid March is that US data remains showing that the economy is healthy, but it has been softer, right? Somehow softer, somehow indicating that the strong pace of growth has decelerated. Not that the economy is shrinking or is at least shrinking. We have high inflation or stable inflation near the Fed target. In fact, the Fed has also said on its past meeting that it will tolerate a spike beyond the 2%, right, until inflation stabilizes. So for most, the data has is telling us that the Fed may not be able to provide the two rate hikes we are waiting for the rest of the year, right? We have three upcoming live meetings, June, September, and December. If the Fed does not anticipate a June move tomorrow, sorry, that will still leave meetings September and December, and it's quite extremely unlikely that the Fed will act in two consecutive meetings, right? So that leaves only December or maybe September, right? And therefore, the market will pressure further the greenback. Another thing that we are seeing in the market these days is that somehow risk aversion diminished. All the political woes going on in the US and Europe that had led the market ever since pretty much Trump won the elections in the US, it's somehow easing, right? And it has become more evident after the result of the French elections a couple of weeks ago with Macron and Le Pen head to head, Macron with a bit advantage. But the definition of these elections that will take place this upcoming Sunday will probably confirm whether this uh, easing risk aversion will continue. The more evident uh, mark in the market that the things are getting, the sentiment is improving, sorry, is the fact that the yen and the gold are really under pressure. Anyway, taking a bit of what happened over these past few days, I have to remark a couple of things. Of course, so far, market has been focused on the manufacturing on PMIs. Chinese data was not that encouraging. Once released, the official country rating release during the weekend. And earlier today, the PICSIN index also came below expected, right? Somehow indicating uh, a slowdown, back risk of a slowdown in the Chinese economy. But we got today also really strong figures in Europe, right? Because despite the European final market PMI came slightly below the flash estimates, it's still at 6 years high, right? So pretty strong reading, another pretty strong reading for the UK, the back pound and the recent rally in pound. And the other thing that we got so far today is another dovish Reserve Bank of Australia, which left rates unchanged at 1.5%, but look a bit more confidence in inflation, particularly based on what we have seen of quarterly inflation over the past couple of days. Anyway, the Reserve Bank of Australia seems to be a bit more relieved over the economic risk, right? And therefore, that would support the Aussie, okay? There's little in the docket in the US today. We have New Zealand employment figures by the end of the American session, early Asian opening. But the fact is that over the more than 10 years that I have spent in the market, I have just once seen New Zealand data affecting the market, right? You know, New Zealand data affects the New Zealand dollar, and it may have a minor effect, temporal effect on the Aussie. So unless you're trading the Kiwi, you should not worry much about this particular figure. Okay. Um, Wednesday, I guess that the most first relevant reading will be GDP data in the euro area. There were pretty tepid numbers, right, coming from the US and UK, somehow contradicting all of the growth that the PMIs are offering ever since the year started. So I will pay a bit more of attention to this number as despite inflation has been rising firmly in the euro area and therefore somehow anticipating the possibility that the ECB will have to change its rhetoric of maintaining QE until the end of the Rabi mandate. Maybe we can get uh, a negative uh, fact from poor GDP growth. Okay. Anyway, we had also the ADP report tomorrow. I do have repeated multiple times that the non-farm payroll report is not what it used to be when it comes to move the market. It has become less relevant, mostly because over the past almost 3 years, the employment sector in the US has been quite healthy, right? We have seen steady growth, steady uh, loads in employment. So therefore, it's not no longer a barometer for the Fed to take any kind of monetary policy decision. The Fed is today just depending on inflation rather than inflation and employment, right? So that's how to make the non-farm payroll report less relevant. And the fact that we are going to get it published on Friday, a couple of days after the Fed, it's giving it less in relevance for this particular week. So unless we have strong deviations in the ADP outcome or in the non-farm payrolls outcome, I don't expect them to move much in the market. The ADP, not much, particularly ahead of the Fed, if we had a reading around the 180 expected, okay? Services and composite final PMIs will also be relevant, but again, I don't believe any of this data could be able to revert the ongoing dollar weakness, okay, against its European rivals, right? We know that the greenback is a mixed bag these days. Uh, we have already talked about the Fed monetary policy and what it could bring, sorry. Thursday, we have the services PMIs in Europe and some data coming from the UK, but nothing really relevant or relevant enough, I would say, to affect the market ahead of payroll. Despite what I said, that I believe that payrolls won't be as relevant as they used to be unless there's strong divergence in the outcome and market expectations. The market will tend anyway to remain cautious ahead of the release, right? Draghi and Pelosi will speak later in the day. Uh, to be honest, I don't expect Draghi to hint a change in its economic and monetary policy outlook, not in a non-ECB speech, right? While Governor Pelosi is expected to express a bit of concern about what Donald Trump is doing with its commercial relationships with the country. You know, Trump has managed to retrieve in the UK from the NAFTA deal, the NAFTA agreement, then later deny it. But the damage to the Canadian dollar has already been done and to the Canadian economy. So uh, mm, it's anyway, it's the same case like in the New Zealand dollar, what we mentioned earlier. It's hardly to see a particularly CAD news affecting the world market, and if it has some effect, it will be temporal and less relevant. Sorry, uh, when compared to the range the dollar CAD can move, right? But anyway, it's something that if you trade, the Canadian dollar should take into account, right? The Reserve Bank of Australia monetary policy statement on Friday won't be as relevant. You know, we had a good anticipation of this usually with the decision, right? And of course, employment figures in the US and Canada will take center stage, okay? They tend to come in line, they're going to be released all together. So um, the focus will probably be in US numbers. We are expecting 180,000 billion new, thousand new jobs, sorry, to have been created in April in the US after the disappointing March reading of 98. Unemployment rate is expected to remain around 4.6, 4.5, even 4.7, despite the short-term disappointment it can trigger, won't be bad enough. As usual, wage, right, average hourly earnings will be more relevant than they used to be as higher salaries, rising salaries imply increasing consumption and therefore will be a boost for the inflation, the boost that we have not yet seen in the US. There will be several Fed speakers, right, coming out on Friday, late Friday, and even one on Saturday. So beware of what they say, beware of if they focus and they keep focusing in the balance sheet or if they move back to rates, okay, because after the Fed meeting this Wednesday, they will be hinting what we could expect from the central bank. Sorry, I sometimes speak too fast. Anyway, changing to charts. Give me a second. So here are my charts. And as usual, let's start with our friend the euro dollar, right? I have flipped the daily chart. You know, this is the high of 1290, 113. We have reached in the day of the US elections, and the low achieved this January. Uh, already forgot about the level 340, right? Sorry. Okay, that's what 3 weeks vacation produces to my brains. Sorry, still playing catch up. Anyway, the sharp decline uh, has become extremely relevant this week, as despite the return of confidence in the euro area that pushed the pair higher earlier last week, it has been unable to break above the 61.8% retracement of such decline, right around 930. We have seen a couple of intraday spikes up to 950, 950, sorry, so 930, 950 is, of course, the main resistance level. And if you take a look at the chart, the low set after that huge spike, it's 1.0820, which it's exactly the 50% retracement of the same decline. So we are clearly trading between these Fibonacci levels, right? And I'm thinking that the overall stance is bullish, no doubts. But I would like to see a pair accelerating through 950. I'm not sure if a break higher today when the slow green higher, meaning the price advancing by 20 or 30 pips in market without a certain period can do the deal because maybe the pair can reach 960 and can pull back lower. We need a big trigger like the Fed or payrolls or ADP or whatever, right? Or Draghi or Yellen something wild to see a pair breaking higher. Anyway, beyond that 950, the logical immediate target comes at 110, followed by this 110.45 area where the pair has held multiple times over the past, um, the second half of 2016. Okay, it's a major static resistance level now, and if we break beyond it, I would expect to rally past at least towards 112. Okay, at least 112 comes to my mind for the upcoming week, of course, if 110.45 gets broken. Okay. On the other hand, I'm talking about short-term supports. The 850 area, right, where the pair bottom multiple times last week is the first support, but indeed the only relevant one comes at 820. Okay, the FIVO and the low post the French elections result low with a break below it, right? Probably open the doors for the pair to fill that gap. For me, it's around 7:30. I'm not sure if you know different platforms, different brokers show different closes. So in between 7:30 and 7:50 is the next bearish target on a break below 820. I can't see the pair falling further below because I'm honestly seeing the dollar being weak and with no much chances of a strong recovery, okay, against this European violence. And for the pound, it was a huge surprise um, uh, call for early elections, and the pair holds on to gains. This latest decline we have seen it this week, I believe it has been corrective and somehow a consequence of profit taking after the pair approach 130. I know it's started like 30, 35 pips away from the level, but still 130 is a major psychological resistance and it won't be an easy to retake, right? Anyway, the decline today, decline we have seen, in fact, since the week started, was reversed today with a strong manufacturing reading. You know, the UK will release its construction PMI, which solely is hardly relevant, but also its service PMI during the coming days. So if both reports also indicate continued growth at the beginning of the second quarter, right, the pound will probably maintain this positive tone. As I said, 29.64 was the high. Above that, 130, 130.10 comes as the next bullish target short term, right? And beyond that level, I do see scope for the pair to keep running up to 130, 115, 16, where we also have a strong side resistance area. You know, another thing that I consider pretty relevant about the pound dollar is that whenever we have strong US data coming out, um, the pound is reluctant to give up, you know. So it needs to be a market shocker, the Fed, and a market shocker, the non-farm payroll report, to drag the pair really lower beyond correction or beyond intraday adjusts. Okay. Anyway, we have fell as low as 28.16 today. That's my first support, and I see a more relevant one around 28.30, right? With pair top multiple times in the previous week, and once broken, triggered the sharp recovery. I believe that as long as the pair holds above this level, chances of a downward move are extremely limited, right? But if somehow this level gives up, the pair has room to move to this 2770 region where it also has a major support. Only a weekly close below this level could trigger a deeper downward move towards 125, something that actually I'm not seeing these days. Okay, for the dollar Japanese yen, it's clear that this ongoing recovery is based on what I was saying about easing risk aversion, right? Uh, the pair broke above 112 overnight, and it's holding around pretty well, looking quite bullish in daily charts. We have the 100 simple moving average of 112.60. So if we somehow move beyond it, the bullish case would be firmer for me with scope to advance up to 1440, 1450 area, right? Uh, but I'm still not quite convinced if the movement can extend that much due to the tepid tone of a greenback, you know. Anyway, uh, the easing risk sentiment that pushed the pair higher persists, and therefore it will depend on US data. You know, this particular pair is more sensitive to US data. So if US data it continues to disappoint, then a decline could be expected. Anyway, what's backing also this advance is treasury yields. You know, the pair has been highly correlated. The yields over the past couple of months, yields are aiming to recover. They plummet to 228 on Friday, if I'm not mistaken, recovered up to 233 right now, the 10-year note benchmark I meant. So, right, so as long as we have yield recovering, chances of a downward move are limited. Even despite yield data could be disappointing, right? Anyway, sorry, 12 is the immediate support, followed by 1160 price zone, and this lows around 111 we have seen last week, right? And to the upside, the 1260 region is my immediate resistance and head at 113, 113.20, a nice bullish target in the case of somehow dollar strength, which honestly I'm not seeing. Anyway, um, the OC is unable to regain its 76 region, and that leaves the risk towards the downside, despite the strong bounce we've seen after the pair bottom near 74.40 late last week. You know, long term, take a look. If we draw a line, right, from year to year, the bearish trend remains firm in place. Lower highs we are seeing weekly basis. So overall, I do see the risk remaining towards downside. But to be honest, the pair seems to be the deal seems to be reluctant to also to this to any form of dollar strength. Most of what we are seeing, the weakness that we are seeing in the OC is coming from commodities, weak prices weakness, right? Gold, oil, and base metals, right? And that is somehow denting the OC. In the short term, the spike we get today up to this high of 75.55 was triggered by the Reserve Bank of Australian decision, right? As I said, it was not as dovish as the market could have expected. But the fact is that soft Chinese data is weighted also on the pair because somehow it's anticipating lower demand from the country and lower sales for Australia at the end, right? Anyway, I can't figure a really bearish picture with the pair breaking lower, but unless we recover the 76 level, the risk towards the upside will be well limited. 76 is for me like a line in the sand. Above it, the pair can go back towards the 77, 77.40 area. But as you know, 77 has been a really tough bone to break, and the pair has been unable to settle above it for 2 years. So any approach to that region will be probably trigger a quick profit shaking, right? Anyway, uh, below 74.90 in the short term, the risk turns back towards downside towards that low around 74.40, followed by 74, right? I can see a case of further weakness in here, but if the pair closes the week below 74, then the main bearish target and the probable next rebuying level, sort of speaking, will be 72.50. Okay, that's what I'm seeing in this particular one today. And getting into gold prices, as I said, risk sentiment is leading the way. The same gap we have seen in the euro towards the upside is in the year towards the downside. The commodities challenging 12.15, the lowest in multiple weeks, as you can see, right? But still, as we discussed multiple times, I do believe that any decline will be limited. Remember, we have productions cost around 11.50, and the Fed is not so hawkish, right? And not so hawkish Fed. will probably favor the gold, right? So beware of that. Anyway, the trend it's towards downside. 1242.50. Okay, this area is for me. Sorry, there. It's the key. I believe that if we take this level downward of 10, it's a probable bearish target in the case that the price settles below. And so far, I'm seeing that the 20 simple moving average in the daily chart currently around 1273. It's containing rallies. So unless we recover above this level, the bullish potential will be limited, right? Above it, then I don't see a stronger recovery back to the highs we've seen lately. Anyway, oil prices had been trading range bound, and despite the wild moves we have seen right over the past April, I don't see much of an upward potential. The market has completely digested the fact that the OPEC is trimming its production, but it's also pricing in and that the U.S. production is keeps on rising. And despite stockpiles have been a bit more encouraging over the past 2 weeks, the fact is that U.S. stockpiles production is at record highs and rising, therefore offsetting any positive outcome from the OPEC, right? Uh, Breaking below 50, but not really following through. The commodities today recovering a bit, but in within range, right? Take a look at the daily chart and all of these dodges and the decline seen on Monday being erased on Tuesday, pretty much telling us the market is not sure what to do with the oil, right? But indeed consolidating around 50, right? Those spikes are being quickly reverted. Those long shadows in the candles are telling me the uncertainty is. Anyway, I don't expect any kind of big news to set a durable trend, right? A long-lasting trend these days. We have stockpiles that can make some noise intraday. I believe that today we have the AP report, not sure after Monday's holiday, and tomorrow the AER report. So that will be looking for those stockpile figures to consider where to trade it in the short term. Anyway, 45.52 is for me the range. That spike up to 54. It's a bit out of my view, but anyway, playing the range 45.52 seems to be the most trustable thing to do with oil these days, unless we have another rough of bad news that can push the pair back towards these lows around 42.50, right? The lows we 43, sorry, the lows seen on November. Anyway, that's it for now. Thank you for sharing your time with me. Hope to see you soon. I believe that we are going to cover live Fed tomorrow, so see you then. Okay. Thank you and bye bye.